Today, I'm going to tell you why I largely avoid US stocks when building my portfolio, and I'm going to give you 4 reasons why you might want to consider doing so also. So to be a true nomad capitalist, you want to be diversified. You want to have residences. You want to have citizenships. You want to have bank accounts. You want to have a proper asset protection plan. You want to know where you're going to go. Potentially you have homes in different countries where when things happen, or just where you want a change of scenery, you have somewhere else to go. These are the elements of being a nomad capitalist. But one thing that I think people often overlook is they're so used to buying stocks either in the United States, no matter where they live, or in their own home country. I happen to think that there are distinct disadvantages to investing in the US stock market, and I'm not saying that I don't do it at all. I'm saying I do it carefully, aware of the disadvantages, and I prioritize only the best stocks in the US, being aware of the whole other universe of stocks out there because of 4 particular reasons that turn me off to the US market. This is not an I hate the US talk. This is being aware of the competitiveness that other countries offer for investors in their country's stocks and why you may want to go there first. So I do have a portfolio of US stocks. I have a yield portfolio that gives me dividends because as Nomad Capitalist, as a company goes forward, I'm choosing to not take money out of Nomad Capitalist. I'd rather take money out of my own assets and use that to live. And that includes very simple bank deposits. It includes stocks that pay dividends around the world. And that's one of the reasons why I actually think the US isn't as good of a market. So let's go through the 4 reasons why avoiding the US stock market, not eliminating it, but being conscious about when you buy stocks there is important. Number 1 is simply lower yields. Let's take the financial sector, for example, and we look at a stock like Wells Fargo. And so Wells Fargo over the last year is down 9 or 10%. It pays one of the higher yields in the financial industry at about 3.25%. You look at Bank of America, also down more significantly over the last year, also at 3.25%. You go to something like a JP Morgan, they're going to be at 2.75, and you have other banks, including some of the regionals that have had problems, that pay less. Now you go to Singapore, for example, some of the strongest banks in the world. Look at OCBC, for example, the overseas Chinese banking company. It's up a couple of points over the last year. The yield is 6.25%. These yields, I'd say across the board, have ticked up a little bit over the course of the last year. I think that yield was about 4.9 or 5%. The yields have increased. And yet in Singapore, that yield is tax-free. Now, if you live in the United States, if you live in some country that taxes you, no matter where you live, the United States taxes its citizens no matter where they live. So if you're an American living in Dubai, you're still going to pay tax on that. If you are a Canadian living in Canada, if you're a German living in the UK, I mean, if you pay tax in a country that taxes whatever you earn, it doesn't matter what they charge you in Singapore, you're going to pay there. But if you're a Canadian or a German who moves to somewhere that doesn't tax your investments, you're going to get that whole 6.25%, whereas no matter where you live, you're going to pay some kind of dividend tax on the U.S. stock. So you get lower dividend yields, and you are going to pay more tax on that yield. Obviously, if you're investing only for capital appreciation, I'll come back to that in a minute, but if you have any kind of yield, actually moving to some of the most tax-free countries, let's say you move to the UAE, you're not going to be able to take advantage, in many cases, in a country like that, of a tax treaty that reduces the dividend withholding tax in a way that, let's say, you could move to some European countries, you could arbitrage it with tax treaties and, let's say, a non-dom program, lump sum program, whatever. You might pay the highest rate of withholding if you're living in a tax-free country. And so let's say you move to Dubai to run a business. They're actually going to make it harder to pay 0% on your business, depending on where it is, but let's set that aside. If your business makes most of the income, your dividend tax might be higher than living somewhere in Europe. And that's because the asset you're investing in is in the U.S. So you've got lower yields is the first reason. And that's just one sector we can look at. If you look at, telephone companies, yeah, like I know AT&T pays a pretty strong yield, kind of a dividend trap of sorts. Look at some of the mobile companies in Asia, higher yields, stronger performance. You see, the Berkshire Hathaway equivalents in some of the Asian countries, they pay, relatively healthy yields. And so if you want yields, they're lower in the U.S. Now let's go to the higher taxes part. We talked about dividends. If you're an American, you're just going to pay tax no matter what. If you're a U.S. citizen, if you live in the United States, it's not going to change. Obviously, there's an issue that U.S. citizens, U.S. persons, no matter where they live, have to pay tax on this kind of thing. So a lot of Americans move to Puerto Rico, for example, to handle this. Or in extreme cases, they just renounce their citizenship and go live somewhere friendlier. Because even if you invest in this stuff in Singapore as an American, you're at a disadvantage. For everybody else, capital gains tax, not a huge issue, but the U.S. has a higher, taxation. The dividend tax, as well as taxed on everything if you're American, just higher taxes all around. There's a third issue that a lot of people aren't aware of. There are estate tax issues. And obviously in the United States, at least for now, there's a relatively high estate tax threshold. And you can do all kinds of other planning if you live in the U.S. in terms of making sure you're not subject to that. But what happens if you own U.S. stocks in your own name, just in your brokerage account, and you're not an American? You think, oh, great, I'm not paying the capital gains tax, and I'm not giving you tax advice here. Okay, maybe I live in a country with a tax treaty that I get the dividend tax down, and maybe I've used some kind of tax planning to where I'm only paying 15% of the dividends. Hey, okay, 15%, that's not so bad. What happens when you die and your U.S. situs assets are subject to tax? This is something we've had a whole bunch of international tax experts that we work with, and they have continually said some of the brokerage accounts that give quasi-tax advice in this are simply wrong. If you die with assets, including U.S. stocks, you may be liable for U.S. estate tax. It ain't a low rate. And the threshold for exemption is practically nothing. It's like 60 grand. It's not millions, $60,000. Now, you can structure that. You can use corporate structures. You can have trusts. You can do different things to hold that. And I can tell you, as someone who's gone through that process, the brokerage accounts don't have to know what they're talking about. So when you work with Nomad Capitalist and you work with our tax people, we can structure something. This is one of the unknown unknowns that a lot of people aren't aware of. We've had people who we sent them over to the tax experts. They would have had a multi-million-dollar bill had they not restructured their U.S. assets. So estate taxes are a thing, and a lot of people aren't aware of it. Now, there's certain unit trusts, there's certain other things that exist to minimize that. But I'll tell you what, most of the private banks, even that you think would have figured this out, they really don't know much about this issue. Mutual funds, unit trusts, things like that may be sold by a bank where it's a basket of U.S. stocks, might be domiciled in Luxembourg to where you avoid that. You don't have to set up a structure. But for a lot of people who are just buying U.S. stocks, just buy Tesla stock in your own name, there's a potential issue there, according to the tax people that we work with. You want an international tax person handling this because most domestic people have no clue how this works. Now, the fourth reason is perhaps a bit more far-flung, but it's simply confiscation. Empires like to take stuff. Smaller countries respect capital. That's not just about the U.S. You saw what happened in Russia and the restrictions on foreigners who had stock investments there. I think that the U.S. is a bit more grabby. They're a bit more aggressive in terms of what they go after. Let's leave it at that. Confiscation. If you want total asset protection, I would rather my capital be in an asset haven where they want my capital there, respect capital. They respect innovation. Let's say you're in cryptocurrency as well. You want to have a bunch of assets in a country that doesn't respect innovation, that thinks that that's a threat. I don't. So those are four reasons you should keep in mind why I keep my U.S. stock exposure less. Not to zero, but less. There's some good companies in the U.S. And again, if you're looking at capital appreciation and you're not a U.S. citizen and you can live in a tax-friendly place, then again, not tax advice, but you're probably going to be in a much better position than someone who is investing in dividend stocks where you can see a much better advantage, even in some European countries on the dividends, depending on where you live, but certainly the Asian countries like Hong Kong, Singapore. Now, alternative for non-U.S. persons, there are, S&P 500 index funds, for example, that are domiciled in Ireland. So there's like a UCITS that trades on the London Stock Exchange, and you can buy that, and there's kind of some protection there, and you actually get a reduction in some of the dividend withholding. And so that's actually what I told my team members to do, not necessarily to buy that, because you can still get the first $60,000 for free. And let's say I have a team, someone who works for me in Georgia. They can just go on their Bank of Georgia and they can trade, S&P 500 index fund. They can buy the VU, and they have decent, tax coverage on their side in Georgia. That may be the easier way just to get started with your first, smaller investments. But on a larger scale, S&P 500 index funds that are domiciled in Ireland and then traded in London, you can do that. And there's actually one that does it actually in dollars, so you kind of eliminate the currency risk there. So if you're not a U.S. person, that might be something to look into. But the bottom line is, yes, U.S. stocks, particularly the tech space, have appreciated very well. If you look at the S&P 500 just in the last year, the tech stocks are what has entirely driven that, as a lot of other stuff has gotten beaten up. If I'm going to be investing in things like REITs, for example, Why wouldn't I want to do that in a place like Asia, where, again, I'm getting more international exposure? A lot of my other stuff is already in the West, but I'm getting a better tax situation. So I'm not an investment advisor. I'm not giving you tax advice, but it's something to think about. Why not have a diversified stock portfolio? Why not start looking at opportunities in other countries for all the reasons that are mentioned? And if you want help setting up the structures, if you want help being connected with all the right tax experts around the world and putting the pieces of the puzzle together, you go to nomadcapitalist.com and we'd be happy to help.